Hello students, this is Professor Vincent Osagai. Welcome to my Intermediate Accounting 1 class, and this is the presentation of Chapter 2, Conceptual Framework for Financial Reporting. Recall in Chapter 1, we talked about financial accounting and accounting standards. We said that accounting standards are the guidelines or the required guidelines that accountants use in performing their work, vis-a-vis in measuring, recording, and reporting accounting information to different interested users. Now, in Chapter 2, our focus is going to be on conceptual framework for financial reporting. The question is, what is that? First of all, I want you to know that conceptual framework is not GAAP, or it is not accounting standard. The question then is, what is it? What is it? It is simply the basis for establishing and revising accounting standards. Now, the question is, what does that mean? Now, let's take a look at the key words here. Conceptual. The word conceptual comes from the word concept. What is a concept? We said that a concept is an idea or theory, all right? So it's an idea of what something is or how it works. What something is or how it works. The framework is the basic structure of something. Therefore, the conceptual framework for financial reporting is a set of ideas and theory that provide support or guidance for establishing and revising accounting standards. Now, let me explain that a little bit further in a different approach. Some people actually consider the conceptual framework for financial reporting as the constitution of accounting. Now, as you know, in the United States of America, the laws of the land of the whole country are shaped and influenced by the Constitution. In other words, the laws of every state, every county, every city has to be consistent with the United States Constitution. Now, for example, the Second Amendment of the U.S. Constitution actually protects the rights of individual Americans to keep and bear arms. A number of years ago, the state of Illinois was the only state in the Union that has a law that prohibits its residents from carrying concealed weapons. Obviously, that law a few years ago was challenged in court, and it was overturned by a federal appeal court on constitutional ground. In other words, the appeal court said this law is inconsistent with the United States Constitution and it cannot hold. So the point is, every law in this land is being shaped and influenced by the U.S. Constitution. So here's my point. Any new accounting standard or the revision of an accounting standard has to be consistent with the conceptual framework. If it is not, then it will not stand the multi-star test. So in other words, the conceptual framework is the basis for developing or establishing and also revising existing accounting standards. So that is the overview of the conceptual framework for financial reporting. So that being said, let's take a look at this chapter again. This chapter is divided into 4 parts. The first part deals with conceptual framework. The second part deals with the first level of the conceptual framework. The second part deals with the second level, and the third part deals with recognition and measurement concepts. So those are the 4 parts of the chapter. Now, that being said, let's briefly take a look at the objectives of this chapter. We have 8 of them. Number 1, describe the usefulness of a conceptual framework. That is the first one that we are going to take on. Now, let's take a look at the first objective here. So the need for a conceptual framework. What are we talking about here? What is the need? Why do we have to come up with a conceptual framework? That need is in twofold. Number 1, the conceptual framework helps us to develop or establish accounting standards consistently. In other words, it helps us to establish consistent set of accounting standards and rules. And number 2, it also helps us when we are faced with a new problem vis-a-vis how do we measure a particular transaction, how do we account for it, how do we report it. When we have such a new problem, we use the conceptual framework as a guide in coming up with accounting standards for that particular new problem. So moving along, the question here is, a conceptual framework underlying financial accounting is important because it can lead to a consistent standards and it prescribes the nature, function, and limit of financial accounting and financial statements. This is true, false question. What do you think? The answer is true. Another question. A conceptual framework underlying financial accounting is necessary because future accounting practice problems can be solved by reference to the conceptual framework, and a formal standard setting body would not be necessary. The answer is false. We still need a formal standard setting body. Moving along, let's take a look at the second objective, and that is we are to describe FASB's effort to construct a conceptual framework. Now, let's take a look at this carefully. The FASB has issued 7 concepts for business enterprises, and we call these concepts statements of financial accounting concepts. FASB calls them statements of financial accounting concepts. Now, here are the 7 concepts. Number 1, objectives of financial reporting. Number 2, qualitative characteristics of accounting information. Number 3, elements of financial statement. Number 5, recognition and measurement in financial statement. Number 6, elements of financial statements. Number 7, using cash flow information and present value in accounting measurement. And number 8, the objective of general purpose financial reporting and qualitative characteristics of useful financial information. So we are going to go through all of these with fine-tooth comb in subsequent slides. But suffice it to say at this point, you probably notice that number 4 is missing on this list because number 4 concept deals with non-business organizations. Moving along, let's take a look at the overview of the conceptual framework a little bit closely. Now, the conceptual framework is divided into 3 pieces. We have the first level, the second level, and the third level. The first level is the most important, and we call that the first level talks about the concepts that talks about the objectives of financial reporting. What is the objective here? What is the overriding objective? What are we trying to accomplish here? So we said this concept, the main objective is to provide, in other words, the basic objective or the main objective is to provide financial information about a particular entity, that is useful for present and potential equity investors, lenders, and other creditors. We talk about this extensively in chapter 1. So the overriding objective is to provide information again, useful information to present potential equity investors. Equity investors, those are investors that buy equity securities of companies. When we talk about equity, means ownership. So if you buy a security that gives you ownership of a corporation, you have bought an equity security. A very common example is common stock. Now, the lenders are parties that extend loan or credit facility to the corporation. They are not owners. They are creditors of the company, and the company is the debtor. So again, I cannot emphasize this enough. The main objective is to provide information about a particular entity that is useful to present and potential equity investors, lenders, and other creditors. Now, let's take a look at the second level. So the first level actually talk about the why. Why are we doing this? Why the third level deals with how do we do it? How do we accomplish that main objective? Now, the second level is the bridge between the first and the third level. So the second level deals with the qualitative characteristics of financial information and elements. What does that mean? In other words, the purpose here is to outline the qualitative characteristics of accounting information. So what are the characteristics that makes for a quality information as opposed to a lot of information? And then the second level also talks about the elements of financial statement. So the third level, like I said, deals with the how. These are the concepts that help us in implementing the basic objectives. So we are going to talk more about this as time progresses. Now, take a look at this diagram. This is a very comprehensive diagram that captures the essence or the picture of the whole conceptual framework. As you can see at the bottom, we have the objectives. Okay, the objective, the question is why? What is the purpose of accounting? Then the second level, like we said, is the bridge between the first and the third level, and the third level deals with the how. Okay, moving along, a question for you. What are the statements of financial accounting? What are the statements of financial accounting concepts intended to establish? Here are the options. The answer is C. The objectives and concepts for developing standards of financial accounting and reporting. All right, moving along. Let's take a look at objective number 3. Understanding the objective of financial reporting. So again, this is a big deal. This is the overriding part of what is the objective of financial reporting. We need to clearly define that in the conceptual framework. So again, like we indicated earlier, it is to provide information about an entity, a business, a company that is useful, and that information has to be useful to present and potential equity investors, lenders, and other creditors in making decisions about providing resources to the entity. Again, we discussed this extensively in chapter 1 as well. So here's a question for you. According to the FASB conceptual framework, the objectives of financial reporting for business enterprises are based on what? The answer is D, the needs of the users of the information. That is the purpose. Moving along, let's take a look at the fourth objective. We are to identify the qualitative characteristics of accounting information. So here we are dealing with the second level, okay, that talks about qualitative characteristics, okay? Like we discussed earlier, we said that the qualitative characteristics of accounting information, we said FASB identified the qualitative characteristics of accounting information that distinguish between information, better or more useful information from inferior, less information for decision purposes. So what does that mean? That simply means the purpose here is to outline the qualitative characteristics of accounting information. In other words, we are zeroing in on quality information, not necessarily a lot of information. So what are the characteristics of quality information? So that is what we are trying to outline here. So here are the issues relative to the second level. Okay, so for the second level is divided into two sessions. You have the qualitative characteristics, you have the elements of the financial statement. Let's quickly go back to the slide. Here's the slide that I'm looking for. So as you can see, at the middle of this diagram, it deals with the second level, which is the bridge between the first level and the third level. And the second level is divided into two parts. You have the qualitative characteristics and you have the elements, all right? The elements of the financial statements. Now, so let's deal with the qualitative characteristics first, okay? And we said that the qualitative characteristics are divided into two. We have the fundamental qualities and we have the enhancing qualities. Under the fundamental qualities, we have relevance, A, and B, we have a faithful representation. So let's back off and let's take a look at that first piece of the second level. So here we have relevance and here we have a faithful representation, okay? So let's take a look at the fundamental qualities. One second, where are we? Okay. Excuse me for a minute. I misplaced my slide and make sure that we are on the same page. Well, here we are. So, the fundamental concepts. So let's take a look at what we have here. The primary users of account information we already established. Those are the capital providers and their characteristics. So we talk about investors and creditors. Investors meaning equity, individuals or investors that have equity or ownership in the company. Then we have cost constraint, we have decision usefulness as the most important criterion, and here we have relevance and faithful representation as the two main issues under the fundamental qualities. So let's take a look at relevance. So under relevance we have a predictive value, confirmatory value, materiality. Under faithful representation we have completeness, neutrality, free from error. Then we have the enhancing quality. So let's take a look at these more in detail. Again, the qualitative characteristics are divided into two: fundamental qualities and the enhancing qualities. So moving along, let's take a look at the fundamental quality, the relevance piece. Okay, so we said that for accounting information to be relevant, it must be capable of making a difference in a decision. In other words, if an information is not capable of making a difference in a decision situation, then the information is not relevant. And there are three ingredients or characteristics of fundamental quality relative to relevance. They are predictive value, confirmatory value, and materiality. Now let's take a look at each of them one by one. Let's take a look at the predictive value. Now what are we talking about here? We said that the predictive value, when information has a predictive value, it has the ability, but it has a value as an input to be able to predict the future. All right. Here we said that the financial information has predictive value if it has value as an input to predictive processes used by investors to form their own expectations about the future. In other words, this information is able to help you to predict the future. Let me give you an example. Let's assume that you are interested in investing in a company and your desire is to receive dividends from the company on a yearly basis. See, not every company declares and pays dividends every year. But if your desire is to receive dividends from this company that you are interested in investing in, and you take a look at the past 25 years, this company has consistently declared and paid dividends consistently over 25 years. That information is good enough for you to safely conclude that it is likely that this year the company very likely will be paying a dividend as well. It might as well be that this year they could not, but just based on the fact that they have been doing it for the past 25 years, you can safely conclude that that information will help you to predict the future. So that is a predictive value for you. Now let's take a look at confirmatory value. Now in this case, this is really the relevant information also help users to confirm or correct prior expectations. Now what does that mean? Now let's talk about the example that I just gave you, whereby a company that declares and pays dividends consistently for 25 years, and because of that information, you wind up concluding that it is likely that they will pay dividends this year and in subsequent years. You decided to invest in the company. Guess what? At the end of this year, which is the 26th year, the company actually declared and paid dividend. So what does that mean? In other words, that information has already confirmed what you predicted. So that is a confirmatory value. So if activity, like I said, the company actually declared and paid in the 26th year, then it actually confirms your prediction or your expectations. So moving along, let's take a look at the third part of relevance, and that is materiality. We said information is material if omitting it or misstating it could influence decisions that users make on the basis of the reported information. Now what does that mean? That's simply a couple of things here. You need to know that materiality is relative. For example, if your neighborhood corporation omitted $50,000 from the sales revenue that they reported, it is likely that that $50,000 will be material. However, for Walmart, that generates over $400 billion in sales revenue annually, if you mistakenly, intentionally or intentionally omit $50,000 from their sales revenue, that is not material and it will not distort the picture of the situation, and that is not material enough to actually influence the decision maker as to whether to invest or not to invest in a Walmart. Moving along, let's take a look at the second part part B of fundamental qualities under qualitative characteristics. And now let me go ahead and repeat that. Again, level 2 is divided into 2 parts. Part 1, qualitative characteristics. Part 2, elements. Under qualitative characteristics, it is divided into 2. You have the fundamental qualities and you have the enhancing qualities. Under the fundamental qualities, you have 2 types. You have relevance, you have faithful representation. So we just talked about the relevant part of the fundamental qualities. So now let's take a look at the faithful representation piece. Now what does that mean? Faithful representation, the slide said here, means that the numbers and distribution match what really existed or happened. What does that mean? Now, for example, we're just using Walmart as an example. If Walmart reports in their income statement that their sales revenue is $480 billion, I think that was their sales revenue for the year 2014, I believe. If they report on their income statement that their sales revenue was $480 billion in 2014, that big number, what they are saying, represent exactly what happened, meaning they generated $480 billion of sales. In other words, they sold goods to customers around the world for $480 billion. So the number has to represent what actually happened. That is what we mean by faithful representation. Okay? Now, faithful representation has 3 ingredients: completeness, neutrality, and free from error. So let's take a look at each of them separately. Number 1, completeness. Now, what does that mean? That simply means every transaction that has occurred has been properly captured and recorded by the entity. That means all the information that is necessary for faithful representation is provided. It's not only captured, recorded, but also reported. Now let's take a look at the second ingredient of faithful representation. We call that neutrality. What does that mean? Obviously, the information without, neutrality. That means a company cannot select information to favor one set of interested parties over another. Now, what does that mean? That simply means that the information must be free from bias. In other words, you cannot stretch the truth or push the envelope and make the situation to be what it is really not. So you have to be neutral when you provide or select information that needs to be provided or reported to interested parties or to the decision makers. Okay, moving along, let's take a look at the no, we're just talking about completeness. I'm sorry. Neutrality. We're just talking about neutrality. A company cannot select information to favor one set of interested parties over another. Now let's take a look at the third ingredient, that is free from error. Now, what does that mean? Obviously, the information without error, in other words, if an information is presented and there is no error in this information, that means the information actually represents what actually happened. So that is free from error. Of course, unfortunately, as you and I know, in real life, sometimes errors do occur. But suffice it to say that the third ingredient is free from error, all right? Information without error will truly represent what actually happened. Okay, moving along, let's take a look at the second piece of qualitative characteristics, and that is enhancing qualities. Enhancing qualities. Now, we have already talked about the fundamental qualities and we said they are relevant and they are faithful representation. Okay, so let me repeat myself again. We are still dealing with the second level of the conceptual framework, which is divided into two: qualitative characteristics and the elements of the financial statements. So we are still dealing with part one, qualitative characteristics. Okay, we said divided into two. We have the fundamental qualities, you have the enhancing qualities. We have talked about the fundamental qualities, which consist of relevance and faithful representation. Here are all the ingredients under both of them. Now let's take a look at the second piece, which is enhancing qualities. So what are the enhancing qualities? The first one is comparability. Now, what does that mean? That simply means that information is measured and reported in a similar manner for different companies is considered comparable. What does that really mean? That simply means if every company is measuring, recording, reporting their accounting information using the same accounting standards, then the users are now in a position to actually compare two companies' financial statements. For example, you are able to compare McDonald's financial statements and Burger King financial statements in terms of assessing their profitability or the financial condition of these two companies. Why? Because they are measuring, recording, reporting their accounting information using the same set of standards or accounting principles. So that is comparability. Now let's take a look at verifiability. Now the verifiability, we said, occurs when independent measures using the same methods obtain similar results. So this deals with the ability for an independent party to confirm the numbers that you are reporting. So if for example, Walmart reports $480 billion in sales, so an independent person can actually come behind them and verify those numbers. Okay, so that is the verifiability. Now, moving along, he said it occurs when independent measurers using the same methods obtain similar results. In other words, the independent people can come in and actually measure and record sales transactions as recorded by Walmart, and they are still going to come up with the $480 billion sales revenue that was reported on their income statement. So moving along, let's take a look at additional enhancing qualities. So we talk about timeliness. What does that mean? This concept deals with the need to provide accounting information to users in a timely manner. If users or interested parties cannot get hold of the accounting information in a timely manner so that they can use it to make a decision, then it does not do them any good. So moving along, let's take a look at the last enhancing quality, and that is understandability. Now, what does that mean? This concept deals with presenting accounting information in an understandable manner or in an understandable fashion. So it's the quality of information that lets reasonable informed users to see its significance. Something that is very important here. The accounting information, every Tom, Dick, and Harry is not in a position to understand accounting information. Let me put it in a different way. In other words, when we prepare financial statements, we are not preparing financial statements with the intention of every Tom, Dick, and Harry to understand those financial statements. You have to be an informed user for you to understand the accounting information that we are providing. So Moving along, let's take a look at Objective 5. Here we are going to define the basic elements of financial statements. Basic elements of financial statements. Now, again, I hate to repeat myself. Here we go. We are still dealing with the second level of the conceptual framework, which deals with two things. Number one, qualitative characteristics of account information, and number two, the elements of the financial statements. So we already talked about one piece of the second level. Now we are talking about the second piece of the second level that deals with the elements of the financial statements. Now, let's take a look at these elements. Here we say we have 10 interrelated elements. What do you mean by interrelated? Of course, they are interconnected, and we are going to deal more about that eventually. And they relate to what? Measuring the performance and financial status of a business enterprise. So here are the keywords. Performance. So when we talk about measuring the performance of a company, what comes to mind? What comes to mind? Another word that we use instead of performance is actually profitability. When you measure a company's performance, you are measuring the company's profitability, or the company's earnings, or the company's operating results. These words are used interchangeably. Performance, profitability, earnings, operating results. So we are talking about the income statement now, because the income statement reports the performance of a company. How well did the company do this month, or this quarter, or this year? You are able to get that information from income statement. Now take a look at the next one. And the financial status of a business enterprise. That refers to financial condition, the financial position. These words are used interchangeably. Now that deals with the balance sheet. Now that being said, those are the two primary financial statements. Of course, we also have statement of cash flows, which is prepared based on the income statement and the balance sheet. So let's take a look at the first one, moments in time. Assets, liabilities, equities. As you know, those are the three elements that are reported in the balance sheet, all right? And we say moment in time. What does that mean? That simply means the information that we report on the balance sheet talks about the financial condition of a company at a point in time. It's a snapshot of exactly what the financial condition of the company is at that particular point in time. If you prepare the balance sheet the following day, the financial condition or position could change the following day. So it's at moment in time. So if you take a look at the balance sheet, take a look at how it is dated. XYZ balance, XYZ company, second line balance sheet. The third line will say as of December, or December 31st, 19 blah blah, or it will say December 31st, 2015, however the case might be. So now let's take a look at the second set, periods of time. Now why do we call this period of time? So now this is dealing with the income statement. Why? Because the income statement reports the performance of a company, or the profitability of a company, or the operating result of a company within a period of time. So you can take a look at the income statement of a company for 1 month. That means from January 1st to January 31st. So what happened in that time frame? Revenues, expenses that were generated in that time, in that period of time. So it could be a month, it could be a quarter, it could be 6 months, it could be a year. Now, the primary elements of an income statement, as you know, are revenues, expenses, gains, and losses. Now, let's back up. Then, of course, we also have investment by owners, distribution to owners, comprehensive income. So now, having said that, let me go back and quickly talk about the definition, because concept number 6 provides us with the definition of each element in the financial statement. All right, income statement, balance sheet. Now, the reason why it's very important for us to have a good understanding of the definition is because for you to report a transaction as or an event as revenue or expense or asset, it has to meet that particular definition. So now we are going to talk about this in great details in subsequent chapters. Suffice it to say, at this point in time, I'm going to just give you a very basic layman understanding or definition of these elements. If you take a look at your book, FASB have a very fancy, very well polished definition of each element, and I think that is on page 53. So I'm not going to have time to actually explain the FASB definition of each element of the financial statement in this presentation. I'm just going to go ahead and give you very simple, straightforward definition. So let's take a look at the assets. See, FASB said probable future economic benefits defined, obtained, or controlled by a particular entity as a result of past transactions or events. In other words, an asset is anything that is owned by a company that has a value that can provide some future benefit to the company. That is basically what we mean by asset. Anything that has a value. So for example, like the garbage can right there. The garbage can is an asset of this university because it has some future economic benefit for the university. But of course, the content of that garbage can or the content of that garbage can is not an asset because it's garbage. Okay, so that is assets. So we have different examples, as you know, cash, accounts receivable, so on and so forth. Liabilities, obligations of the company. In your book, FASB gave it a very nice, fancy, polished, very official definition. In classroom, we are going to talk about all those fancy, very polished definitions, okay? Now, equity, ownership. In other words, the difference between assets and liabilities will give you, in non-for-profit arena, we call it net assets, or here we call it equity. All right? Now, let's take a look at the period of time. Investment by owners. What are we talking about there? Investment by owners also means owners, we call them capital, investment, contributions. When the owner contribute money into the company or put in capital into the company, these words are used interchangeably. So we call those investment by owners. Okay. Now, how do we normally manifest that, or how does that normally manifest itself? The owner contribute money into the company, then of course the company would issue stock, common stock, to the investor. Now the second piece is distribution to owners. Dividends. You already know what dividends are. That is part of the profit of a company given to the owner or owners. We just give it a fancy name, we call it dividends. Now, comprehensive income. See, comprehensive income is the sum of net income and other items that should not be in the income statement or should bypass income statement. A good example would be unrealized gain. We are going to talk more about those in details in subsequent chapters. Now, revenues. Revenues are simply the amount a company earns for either providing services or selling goods or manufacturing goods. Okay, every company does one of these three things. One company is either providing services or selling goods or manufacturing some product. So whatever that main or the core of the business is whatever money that they realize from doing while they are in existence, we capture those and we call them revenue. Okay, so amounts earned by providing services or selling goods or producing goods in activities that present the company's main operation. So the key word is it has to relate to the company's main operation. Expenses. Expenses are the amounts that the companies incur in providing services or selling goods or manufacturing goods. In a layman's term, expenses are the cost of doing business. You probably have heard this before and say, well, you have to spend money to make money. That is the money that we spend or the cost of operating the business. Now let's take a look at another one, gain. Now gain or gains relate to incidental transactions that result in increase in equity. Now let me give you an example. Let's assume that Walmart decided to sell some of the computers that they have been using in their accounting department because those computers are old. Now, if Walmart decided to sell those computers that they are using in their accounting department for the past 3 years, and they're able to sell those computers, used computers, more than the book value, that is a gain. That is not revenue, because Walmart is not primarily in the business for selling computers. I'm struggling with this example right now because I know that Walmart sells almost anything and everything, but I'm not talking about the computers on the shelf. If Walmart has some computers on the shelf that they normally sell, I'm not talking about those ones. Those ones will be recorded as revenue. I'm talking about the computers that they use in their accounting department, okay? So if they're able to sell those used more than the book value, it is gain. Now, not revenue. So if they sell those computers less than the book value, then that is a loss. So gains, losses are incidental transactions that result in either increase or decrease in equity. So we are going to talk more about all of these basic elements in greater details in subsequent chapters. Question for you. According to FASB Conceptual Framework, an entity's revenue may result from D, a decrease in a liability from primary operations. So the key word is primary operations, like we just described. Moving along, let's take a look at the objective C. We are to describe the basic assumptions of accounting, the basic assumption of accounting. Now we are done with the second level of the conceptual framework. Now we are going to get into the third level of the conceptual framework. As you know, the third level deals with how do we meet the objectives of the first level. So the third level is divided into 3 categories. We have the assumptions, we have the principles, we have the constraints, okay? So let's take a look at the first one, assumptions. So these are the basic assumptions, okay? Number 1 assumption is economic entity, meaning the accounting and the business activities of the company have to be kept separately from the owner or owners of the company. In other words, the economic entity is saying that the company and the owner or owners are separate and different for accounting and business purposes, okay? So that is what economic entity is all about. It's an assumption. Now, see, because of that assumption, as we discussed in principles of accounting, if you decide to start a business today, let's assume that you saved about $50,000 over the last 10 years. Now, that $50,000, you have to write a check from your personal checking account and open a separate checking account for the business. and deposit that $50,000 into the business checking account. Then the company will issue you a stock for your investment. Why? Assuming that you even have 100% ownership of the corporation, because there are some corporations, we call them closely held corporations, that are owned by one individual. Why that is true, the fact of the matter is, for accounting purposes, the assumption is you, the owner or owners, for business purposes, your finances should be separate from each other. Why? Because if you don't and wind up commingling funds altogether, then measuring the performance of the company or determining the financial condition of the company becomes very fuzzy if you are mixing other entities' finances into that company's accounting records. So that is the economic entity. Because of that assumption, we do certain things that we do. Now, moving along, the second one is going concern. What does that mean? The assumption here is every company that is in existence is going to be there forever. That is the assumption. And that is not necessarily true, but we need to hold that assumption to be true in order for us to engage in certain business transactions. For example, a company will start, a new company would have 10 years lease with the landlord, even though in the United States, about 85% of new businesses fold up within the first 5 years. Why that is true, when you establish a company, have you seen anybody start a company and say, in about 3 years' time, I will be out of business? Everybody is optimistic that the business is going to be there forever. So when we look at a company, we look at the company from the lens of the company being there forever, and that is why we're able to get into some commitment, long-term commitments and whatnot. As a matter of fact, I think in the city of Chicago, a number of years ago, the city of Chicago got into a contract with a company to manage parking meters across the city, and I think the contract was for 75 years. I think either the parking meter or Midway Airport contract. Anyway, moving along, let's take a look at the monetary unit. Now, what are we talking about here? This is an assumption whereby money is the common denominator, and we don't make adjustment for inflation when we do the reporting in terms of measuring, recognizing, and reporting accounting information. Now, the next assumption is periodicity. What are we talking about here? You cannot, this is an assumption that says you cannot just continue to operate your business on an ongoing basis without a time out and put your house in order and figure out exactly how well the company is doing. Is this company profitable or not? What is the performance of this company? What is the operating result of this company? You need to know sometimes. How frequently? For some companies, they have to know every month. So in such circumstances, we say those companies have, their accounting period is every month. In other words, they have to prepare their financial statements and go through the accounting cycle every month. For some companies, it could be quarterly. For some companies, it could be semi-annually. But every company has to have a time out. That is what we call periodicity. At least once a year to put your house in order and figure out what is your performance, what is your financial condition. Why is it that every company must do it once a year? Because somebody that is bigger than you and your company, that is the government, said you have to do that every year so that you can determine how much check you need to send to the federal government or the state government or both of them. Now, that is the periodicity assumption. Now, moving along, here are some questions relative to the application of the assumptions that we just talked about. So you can go through these on your own. Moving along, let's take a look at the objective number 7. And that is, we are going to explain the application of the basic principles of accounting. Now, here we said that the most commonly used measurements are based on historical cost and fair value issues. So now we are talking about some basic principles now, all right? We just talked about some assumptions. Now we are talking about some basic principles, okay? Now, in other words, how do we measure transactions? Again, the slide said the most commonly used measurements are based on historical cost and fair value. What is historical cost? The historical cost requires us to record and measure transactions based on their historical value, based on what you actually pay for it. So, for example, if you buy a property for $100,000, you record it as $100,000, and you continue to carry that property for $100,000 in your books, even for the next 30 years. So in 30 years from now, that property is probably valued or worth $1 million, but in your books, it is still $100,000. As a matter of fact, the book value will be zero, because if you depreciate it over X number of years, you have the cost as 100,000, accumulated depreciation as 100,000, and the book value will be zero. Now, that a lot of accounting users have problem with reporting information using historical costs, because they said it doesn't really portray the financial condition of the company, which is true. So then the next alternative is what we call fair value information. The fair value information is more useful. Why? Because it actually reflects the fair value of the information that you are reporting in your financial statements. Now, the problem with fair value is if you allow people to report assets in their financial statements based on fair value, people are going to be coming up with so many bogus figures. Oh, I bought this property 2 years ago for $250,000. Oh, it's now worth $750,000. So you really don't know what it's worth. But nevertheless, at this point in time, FASB has given companies the option to use fair value as a basis for measurement, for measuring financial statements and financial liabilities. And they are very, very selective as to the assets and liabilities that you can measure using fair value option. All right. So here you have it with the measurement principle. So now we are talking about principles now. The first part was we talked about assumptions, okay, under the third level. Now we are talking about the principles. So the next one is revenue recognition principle. This principle requires that company recognize revenue in the accounting period in which the performance obligation is satisfied. What does that mean? That simply means we need to record and report revenue when earned. When do you actually earn revenue? We just indicated that every company does one of three things to generate revenue or to generate income. Every company does one of two things to be in existence at their main operation. You are either providing services, or you are selling goods, or you are manufacturing or producing goods. So the question is, when do you recognize revenue? When it is earned. For a service company, when services have been provided and there is no more obligations on the part of the company. For a company that sells stuff like Walmart, we call them merchandise type of company, when they sell goods to you, then they have already earned that revenue and it has to be recorded and reported. For a manufacturing company, by the time they are done manufacturing whatever product that they manufacture and sell the goods that they manufacture, that is when the revenue should be recognized. The word recognition in accounting also means what? Record. By recording something, you are recognizing it. So that is the underlying principle of revenue recognition. We are going to talk more about this in great detail in another chapter. Now, let's take a look at expense recognition. It said here, let the expense follow the revenues. What does that mean? That simply means that expense should be recognized or recorded when incurred, when you have the obligation to actually pay the amount. So, as we know, expense deals with the cost of operating your company. Now, let the expense follow the revenues. Here we are saying the revenue that you generated in January or the expense of January should be matched with the revenue that you generate in January, or the expenses for this year should be reported along with the revenue of this year. Each accounting period stands on its own. And what is accounting period? It could be month, it could be quarter, it could be year, semi-annual, it could be a year. So, moving along, here they talk about different types of costs here. They talk about product cost, period cost. For period costs, those are costs that are expensed. You write them off completely in the accounting period that we are dealing with. Product cost, if you manufacture something and you have not sold it, it is not a cost here. It is part of your inventory. It's considered as an asset. So we call those product costs or inventoriable costs. In other words, you carry them over to the next accounting period. It becomes cost by the time that particular good that you manufactured is sold. Okay. So, here is the illustration of the basic principles that we just talked about. So you can go through this on your own. So, additional basic principle is called full disclosure. What does that mean? Providing information that is of sufficient importance to influence the judgment and decisions of an informed user. Now, I want to bring your attention to this, okay? Full disclosure is very important, okay? It is an integral part of the financial statements, okay? So, take a look at the example that I have here for you. I don't know whether you can see this, but this is ExxonMobil financial statements, okay? Now, the ExxonMobil financial statements here, this is True Life financial statements. They have 38 pages. No, I'm sorry, let me back up. The financial statements, vis-a-vis the balance sheet, income statement, statement of cash flows, statement of stockholders' equity, so on and so forth, 6 pages. 6 pages. However, the subsequent pages after the 6 pages, we call them notes to the financial statements. Those are narrative explanation of the policies and procedures underlying the numbers. Those are notes explaining further what the numbers actually means, the principles that we use in reporting the numbers. So there are a lot of information about the numbers on the financial statement that the numbers cannot actually tell you. So we have to explain further in notes to the financial statement, more or less like, you know, a footnote, all right? But here is my point. If you take a look at this financial statement, they span over 32 pages, and the financial statement 6 pages. So combine these, you have 38 pages. So these financial statements is not just 6 pages, it's 38 pages because the notes to the financial statement, that is what we mean by full disclosure, is an accounting principle, it's an accounting standard that says you must disclose, you must have footnote, notes to certain things that needs to be explained away in the financial statements. So we said that the notes to the financial statements are an integral part of the financial statement. So you have 38 pages here altogether, not just the 6 pages of the main financial statements. Okay, moving along, here are some exercises illustrating the basic principles that we just talked about, all right? So you can go through these on your own. So those are the 4, we have various accounting principles, but the 4 basic principles that we just talked about is the meat of accounting principles. Now, the last objective, let's take a look at the cost constraint on reporting accounting information. What does that mean? What does that mean? That simply means, here they said that the cost of providing information must be weighed against the benefit that can be derived from it. What does that mean? In your other business classes, you must have come across this concept called cost benefit analysis. Not only for accounting for that matter, cost benefit analysis simply means it makes sense to take on something when the benefits outweigh the cost. If the cost is more than the benefit, it's not worth it. For example, it costs you something to pursue a college degree, true or false? What does it cost you to pursue a college degree? Time, money, headache, stress, frustration, having to take exam and all those stuff. Those are the costs of obtaining a college degree. Why are you pursuing it? You are pursuing it because hopefully and prayerfully you hope that the benefits would outweigh the cost. The benefit in the future would outweigh the cost. If otherwise is the case, then you won't be here. As a matter of fact, some people are not here because they don't think in their mind, that is their own conclusion, the cost outweigh the benefit, and they said, you know, I don't want to be bothered. I'm just speaking generally. So bottom line is, that truth is also applicable when it comes to providing accounting information. In other words, the cost benefit analysis is also applicable in providing accounting information. Moving along, summary of the structure that we just talked about. All right, we are almost there. Some relevant facts that I want to bring to your attention. In 2010, International Accounting Standard Board and FASB completed the first phase of a jointly created conceptual framework. In this first phase, they agreed on the objective of financial reporting and a common set of desired qualitative characteristics. So FASB, United States FASB, and the International Accounting Standard Boards, these are 2 bodies that are responsible for setting accounting standards. They are now working together to come up with the same conceptual framework. This is part of the process of actually merging US GAAP and international GAAP. Now, number 2, the existing conceptual framework underlying GAAP and IFRS are very similar. IFRS, these are the International Financial Reporting Standards. So we call ours GAAP, they call theirs International Financial Reporting Standards. Okay, the convention framework should be a single document, unlike the 2 conceptual frameworks that presently exist. it is unlikely that the basic structure related to the concepts will change. Additional relevant facts that I need to leave with you. Both IASB and PASB have similar measurement principles based on historical cost and best value. In 2011, the board issued a converged standard fair value measurement so that the definition of fair value, measurement techniques, and disclosure are the same between GAAP and IFRS when fair value is used in financial statements. Here are some differences. Although both GAAP and IFRS are increasing the use of fair value to report assets, at this point, IFRS has adopted it more broadly. As example, under IFRS, companies can apply fair value to property, plant and equipment and natural resources, and in some cases, intangible assets. Believe it or not, that is the conclusion of Chapter 2, Conceptual Framework for Financial Accounting Reporting.